Today, we're diving into another deep financial statement breakdown, and this time the spotlight is on Alphabet, trading under the ticker symbols GOOG and Google, better known worldwide as Google and YouTube. This is not just another tech company. Alphabet is a giant with a market capitalization now pushing nearly $4 trillion. Before jumping straight into the financial statements, let's first set the stage by looking at the company's Q3 results, which were released about a month ago and cover the period ending September 30th. If you've been holding Alphabet stock over the past year, the results have been exceptional. As of December 20th, Alphabet is up roughly 61% in 2025 alone. Over the most recent month, the stock has gained around 4%, which is roughly in line with the broader market. For context, the overall market is up about 15% year to date. Now, if we zoom out even further, the long-term picture becomes even more impressive. Over the past 5 years, Alphabet shares have climbed more than 250%, recently trading close to an all-time high near $320 per share. Just looking at the past year's chart tells a powerful story. Seeing a company with an almost $4 trillion market cap rise 61% in a single year is a reminder that even the largest corporations in the world can still deliver outstanding returns over relatively short periods of time. With that context, let's move directly into the SEC filings. These are Alphabet's Q3 financial statements for the quarter ending in late September, and will highlight the most important areas quickly and clearly. Starting with the balance sheet on page 6, a few numbers immediately stand out. Alphabet is currently holding close to $100 billion in cash and cash equivalents, including marketable securities, an enormous financial cushion. Another major development over the past year appears in property and equipment. If you follow other big tech companies involved in cloud computing and artificial intelligence, this trend will look familiar. The industry is in the middle of a massive spending race, and Alphabet is right in the thick of it. The company is investing heavily in servers, networking equipment, and data centers, all designed to support growing demand from cloud services and AI workloads. One more balance sheet item worth noting. Alphabet's debt doubled over the past year, rising from approximately $11 billion to $22 billion. However, when compared to nearly $100 billion in cash, this level of debt is insignificant and not a concern at this stage. Now, let's step back and look at the business from a higher level. Over the most recent quarter, Alphabet's revenue increased by nearly $16 billion, rising from $88 billion to $102 billion. Looking at the first 9 months of the year, revenue climbed from $253 billion to approximately $290 billion, representing very strong top-line growth. That revenue growth flowed directly into profits, with net income jumping from $26 billion a year ago to $35 billion in the latest quarter. Alphabet also provides a brief description of its business model in the filing. Founded in 1998 in a California garage, Google describes its core operation as generating revenue through relevant, cost-effective online advertising. Advertising remains the foundation of the business, but Alphabet also offers cloud-based solutions to enterprise customers, including infrastructure, platform services, and applications. While Google has historically been almost entirely advertising-driven, its push into cloud services now puts it in direct competition with companies like Microsoft and Amazon. Breaking revenue down by segment makes this even clearer. Google Search remains the dominant contributor, generating $56 billion or nearly 60% of total revenue in the quarter. YouTube ads added another $10 billion, and YouTube's scale now far exceeds that of many major streaming platforms. Combined with the Google network, Alphabet's advertising business produced approximately $75 billion out of $102 billion in quarterly revenue, roughly 75% of the total. Beyond advertising, Alphabet generated about $13 billion from subscriptions and platforms, including services like YouTube TV. Then there's the cloud business, which Alphabet is aggressively expanding, including a major acquisition scheduled to close soon. Finally, there are the company's other bets, primarily focused on autonomous vehicles. While these projects generate minimal revenue and currently operate at a loss, they represent long-term strategic investments. Alphabet is also highly diversified geographically. The United States accounts for about 48% of revenue, while Europe, the Middle East, and Africa contribute 29%, and the Asia-Pacific region adds 17%. This global exposure provides meaningful diversification. Returning briefly to debt, the increase to $22 billion is not problematic. Alphabet doesn't need debt, but issuing it, particularly in different currencies, can be more efficient than moving cash across borders and triggering taxes. As a result, the company issued euro-denominated notes and about $5 billion in new U.S. debt. Capital spending has surged as well. Property, plant, and equipment increased from $171 billion to $223 billion, an additional $53 billion year over year. Nearly all of this increase relates to technical infrastructure, including servers, network equipment, and data center land and buildings. Like Amazon, Microsoft, and Meta, Alphabet is racing to expand capacity to meet growing cloud and AI demand. One notable drag on profitability this year was a European Commission fine of nearly $11 billion. While painful, regulatory penalties are part of operating at Alphabet's scale. The company also announced plans to acquire Wiz, a cloud security platform, in an all-cash $32 billion deal expected to close in 2026. This acquisition should significantly boost Alphabet's cloud revenue, likely pushing it well beyond the roughly 15% share of revenue it represents today. Alphabet continues to face numerous antitrust investigations worldwide, but these are not viewed as existential threats. While fines can impact quarterly results, as seen this quarter, they are largely the cost of dominating markets like search and online advertising. Turning to shareholder returns, Alphabet repurchased about $12 billion worth of stock over the past 3 months. Dividends totaled only $1.2 billion, showing that management prefers buybacks as the primary method of returning capital. Looking at profitability by segment, Google Services generated $33 billion in operating income on $87 billion in sales, making it an extremely profitable business. The cloud segment delivered $15 billion in revenue and $3.5 billion in profit, a significant improvement year over year and clear evidence that AI and cloud investments are paying off. Meanwhile, other bets posted a $1.4 billion loss, slightly worse than the $1.1 billion loss a year earlier, but still immaterial to the overall business. Management highlights paid clicks and cost per click as key performance metrics. Both remained strong this quarter. Paid clicks grew 7%, accelerating from 4% previously, while cost per click rose 7%, remaining stable over the past 9 months. Traffic acquisition costs increased from $14 billion to $15 billion, but overall cost of revenue stayed around 40% of sales. Alphabet also spent roughly $15 billion on research and development, about 15% of total revenue, a level of investment only a handful of companies in the world can sustain. Finally, valuation. Based on discounted cash flow analysis extending through 2035, Alphabet's intrinsic value is estimated at $312 per share, compared with a current market price of about $313. Even after a 60% rally in 2025, Alphabet remains a dominant business capable of long-term growth. Adding nearly $1 trillion in market value over the past year shows that this company is far from finished. Finally, let's talk about valuation and whether Google is actually a buy at today's price. Based on discounted cash flow analysis extending out to 2035, Alphabet's intrinsic value comes in around $307 per share, while the stock is currently trading near $313. That tells us the stock is trading slightly above what the fundamentals suggest is a fair entry point today. Now let's look at what Wall Street thinks. At the moment, 62 analysts are actively covering Google stock. Out of those, 53 analysts have issued a buy rating, while 9 have a hold rating. There are currently no major sell ratings, which speaks to the overall confidence in the business itself. When it comes to price targets, the 12-month analyst estimates range widely. The highest price target sits at $400, while the lowest comes in at $185, which frankly seems quite unreasonable given that nothing material has changed in Google's business fundamentals. The median 12-month price target is $325, which gives us a more realistic expectation. It's important to understand the difference between these two valuation tools. Intrinsic value helps investors identify what might be a good entry price today based on fundamentals. On the other hand, analyst price targets are forward-looking and attempt to estimate where the stock price could be 12 months from now. So when we put this together, a current price around $313, a median 12-month target of $325, and an intrinsic value of $307, the expected upside doesn't look especially compelling. From a pure return perspective, this setup doesn't offer the kind of opportunity many investors look for, especially if you're targeting a minimum 25% return over the next 12 months. That said, it's important to be clear about one thing. Google is a Hall of Fame business. It is dominant, highly profitable, globally diversified, and built for long-term growth. This is not a company in decline. However, great businesses don't always make great buys at every price. At current levels, Alphabet doesn't appear to offer a particularly attractive entry point. In my view, the smarter approach right now is to keep Google on your watch list. If the stock pulls back meaningfully or experiences a broader market-driven correction, that would be the time to reassess. If the price falls and the fundamentals remain intact, that could present an excellent opportunity to buy Google stock at a valuation that offers above average returns compared to the S&P 500. Thanks for watching, and until next time, keep investing.